If you're considering a Roth conversion, I can almost guarantee this: you're not thinking about it in levels. Most retirees think it's a simple decision of convert or don't, but Roth conversions aren't one big switch, they're a series of opportunities, and missing just one of these levels could cost you thousands, if not hundreds of thousands, in lifetime taxes. In today's video, we're going to walk through the 4 levels of Roth conversions you must know. And if you listen until the end, I'll reveal a bonus 5th level, not for the faint of heart, but extremely powerful if done right. I'm John Norberg, and I have helped numerous retirees and pre-retirees figure out not only when to convert, but how to do it in a way that protects their future income, reduces their Medicare penalties, and passes on more to their families. And that's what today's financial prop video is about. At Norberg Wealth Management, we do this kind of thing every day. By the end of this video, you're going to know exactly what kind of Roth conversion strategy fits your income, age, retirement timeline, and how to avoid those expensive mistakes. Alright, level 1, the tax-free threshold. Let's start with one of the most underrated tools in the toolbox, the tax-free threshold. Most people don't realize you can convert to a Roth IRA and pay 0 in federal taxes if your income is low enough. This is especially powerful in the early years of retirement. Think about the moment you step away from full-time work. If you're like most people, you're going to find that your income likely drops. But that drop isn't just a lifestyle change, it's a planning opportunity. Take a client of mine who recently retired, living off of after-tax investments with minimal taxable income, had sold a property the year before and had some cash cushion. He wanted to delay Social Security past full retirement age, probably to about 70. We ran the numbers, and he could convert almost $30,000 completely tax-free. That's money moved from forever taxed to never taxed at no cost. That's a huge deal. This opportunity does not last forever, though. Once Social Security kicks in or those required minimum distributions begin, that tax-free window starts to close. Now, if your projected income falls under the standard deduction, which is $15,750 for single filers or $31,500 for married couples in 2025, you have a golden window. And remember, this is the adjusted gross income, not your gross income. That is a key distinction that can save you thousands. When you couple this strategy with the fact that the 0% capital gains bracket, which exempts long-term capital gains up to $48,350 for single filers and $96,700 for married couples, this means that you can still draw income off of your investments to live on while also making substantial Roth conversions and potentially paying nothing in taxes for the privilege of doing so. But the sad truth is, many retirees miss this entirely. They think, well, I'm not making much this year, I'll just coast. But that's exactly the year to act, because doing nothing in a low-income year is leaving tax-free opportunity on the table. So let's talk about level 2, marginal tax rate maximization. Think of your tax bracket like a cup. Most retirees only fill it up about halfway. Now, let's say you're in the 12% bracket in retirement and you convert just $10,000. But the bracket goes all the way up to around $96,000 for a married filing jointly couple, meaning you potentially left a lot of money on the table. Now, that unused space doesn't roll over, it disappears. And later in retirement, when RMDs push you into 24% or 32% brackets, you might wish you had used it. And this is the heart of efficient tax planning, filling the cup to the brim but never overflowing. By doing so, you can help flatten your future tax liability, protect against rising rates, and minimize Medicare penalties. Here's a story. A couple I worked with, let's call them Jim and Rebecca, had a combined taxable income of about $70,000 in 2023, thanks to some strategic deductions. That left them within the 12% bracket by a good margin. But they were only converting $10,000 to Roth each year, well below their bracket ceiling. We ran the numbers and showed them they could safely convert an additional $25,000 without fear of jumping into the next bracket, while also being cognizant of IRMA surcharges. That $25,000 converted at 12% would have likely been taxed at 22 or 24% more within the decade once their RMDs began. That one change saved them potentially $100,000 or more in projected lifetime taxes. Now, before we move to level 3, where we start layering in Social Security and strategy, I want to pause for a moment. If you're watching this and thinking, this makes sense, but not sure how it applies to me, you're not alone. This is exactly why we offer a free personalized retirement review. I'll personally record a video walking you through your numbers, your income, your accounts, your timing, and show you exactly what those numbers could mean for you. It's private, personalized, and there's no pressure or obligation. Just a simple video showing you what's possible and what to avoid. Click the link below, fill out the short form, and we'll get to work. Let's take the guesswork out of your tax strategy together. All right, so let's jump right on into level 3, strategic Social Security delay. Delaying Social Security isn't just about a bigger paycheck, it's about creating tax planning runway. Those years between retirement and age 67 or 70 are often some of your lowest income years from a tax perspective, and that low income is an invitation to convert more while paying less. Every dollar you move from IRA to Roth in this window is one less dollar that forces up taxes or Medicare costs later. It's also one more dollar that grows tax-free for the rest of your life. Let's bring in an example. A story I heard recently involves a married couple, called them Mark and Susan, who had decided to retire at 62 but delay Social Security to 70. That gave them 8 full years of minimal income, during which time they were able to convert $400K from their IRAs to Roth IRAs, all at the 12 and 22% tax brackets. When Social Security kicked in at age 70 and RMDs at 73, their brackets stayed manageable, Medicare charges stayed manageable, and they avoided that steep tax cliff that so many retirees face at R&D time. Here's the kicker. Their Social Security benefits were also higher because of the delay, and because their income was controlled, the tax on those benefits was also lower. That is what I call a win-win. This strategy is particularly powerful for single retirees or those with significant taxable savings. You're essentially buying time, and time in retirement planning is everything. All right, so let's get into level 4, estate and survivor planning. Here's the part most planners forget to model. What happens when one spouse passes away? It's called the widow's penalty, and it's real. What was taxed at 22% could suddenly be taxed at 32%. Add in IRMA charges, and the financial pain grows quickly at a time when you're already heartbroken. Take, for instance, Linda, who lost her husband in her late 60s. They'd always thought they would start Roth conversions at some point, but when she inherited the full IRA and had to file as a single taxpayer, her tax rate jumped significantly. Her tax didn't change, her spending didn't change, but she ended up paying over 40% more. This isn't meant to be a scare tactic, it's the mathematical reality of what the tax code could do to you if you're in that situation. So Roth conversions, while both spouses are alive, can in fact prevent that. By converting when you have control, when you have time, you're able to preserve those dollars in a tax-free manner, which, by the way, can also mean a tax-free legacy for your heirs. It's a huge estate planning tool too. Which brings me to the bonus level, the all-in conversion. This one is not for the faint of heart, but in the right scenario, it's transformational. The all-in Roth conversion is just what it sounds like. You move your entire traditional pre-tax retirement account to Roth in one bold move, or a couple of large chunks. I'm reminded of the story of Ted Weschler, who made the news a few years ago as having one of, if not the largest known Roth conversion in history. Ted worked for Warren Buffett and was very successful. He had turned his $70,000 IRA into a 9-digit traditional IRA. Then, at 2012, he took advantage of a new area in the tax code, the Roth conversion, to take that $100 million plus traditional IRA and convert it to Roth. He paid a fortune in taxes, $29 million is the number that's out there, for doing so. But now, that IRA, that Roth IRA, is supposedly worth well north of $250 million. When it comes to thinking like the rich, it's a strategy like this that can give ultimate predictability and control of your tax picture. Yes, again, you'll pay a fortune in taxes, but sometimes that can be worth it, particularly if you foresee being in the top tax bracket for the rest of your life. It's not for everyone. You need the cash flow, the tax tolerance, and the long-term vision. But when the stars align, this move can be a reset button which gives you decades of freedom and a legacy on which your heirs will never have to pay taxes either. So, let's recap. First, we talked about the tax-free threshold, where you capture your free conversion window early on in retirement. Then we talked about your marginal rate maximization, where you fill your bracket now rather than waiting for later when RMDs kick in. Then we talked about strategic Social Security delay, using those low-income years wisely. And then we talked about estate and survivor planning, protecting your spouse, preserving your legacy, and not leaving them with a tax bomb. And then finally, the all-in conversion, that bold move for long-term freedom, ultimate control, and a tax-free legacy. So Roth conversions aren't a single switch. They're a series of strategic choices, each with the potential to reshape your retirement. And if you want help figuring out which level you're in or which you should aim for, click the link below. We'll start by recording a video walking you through the numbers you've provided to help you see where your numbers and your goals align as you work towards taking greater control of your financial and tax picture. Because the truth is, retirement isn't about rules, it's about rhythm. And when you find the right tax rhythm for your life, the results can be truly transformative. So thanks again for watching, and in the meantime, I'll see you out there.